I am a strange eater. If I have 3 different things on my plate, I will not move on to the next thing until I finish the last thing. So if I have steak and beans and potatoes, I'll finish the steak first, right? You always finish the steak first, then I'll move on. I do it in kind of a systematic fashion like that. Quarantine everything off and do it one at a time. Now, I'm not a psychologist, but thankfully I'm not a psychologist, but I think it's probably a left brain, right brain type of thing. Why do I say that? Because my wife, who is less analytical than I am, but yet more creative, more of a right brain person than I am, she'll do a little bit here, a little bit there, back to the steak, back to the beans, back to the potatoes. Again, I think it's a left brain, right brain thing. By the way, question for you. Number 1 is, are you analytical or right brain? And number 2 is, do you eat like I do or do you eat like my wife does? I'd be willing to bet that if you're of the analytical mindset, that you probably are thinking, yeah, Charlie, I'm just like you as far as that. Or maybe I'm just crazy. I don't know. Now, why do I bring all that up? I bring that up because this sequel to a video that I did previously, which was entitled How Charlie and Noelle Plan to File for Social Security Benefits. By the way, you need to watch that video before this one. Click stop if you have not seen that. Go into my YouTube channel and watch that video. By the way, click subscribe. I do these videos more than weekly, a few times a week, and also like the video if you like it. But this is a sequel to that. And what I want to talk about in this is the method to the madness from a tax standpoint of that filing strategy, Social Security filing strategy that I discussed in that first video, because there is more of a method to the madness than what I discussed there. And that has to do with taxation. It has to do with eating the tax bill, so to speak, in more of a quarantine fashion, how I eat, versus the mix and match fashion in retirement. So quarantining off one versus the other, at least relative to the mix and match design. And by the way, the mix and match design of taxation, which I'm going to elaborate here on in a bit, that is typically what consumers do, right? Is they hit their retirement age, 65. A lot of us think of retirement age as 65. That's the benchmark. Hit retirement age, I'm going to go on Social Security, and whatever I need above and beyond Social Security, well, my retirement assets, I'm going to withdraw from that. That's easy. It takes no planning, right? It's very easy, which is why a lot of folks do that. I want to submit to you that you take more of a planned approach, more of a quarantine approach, and I can help you with this plan. I can help you create a plan, whether you're a consumer or whether you're a financial professional working with consumers. I can help you with this quarantine structure here. So let's jump into what I mean by the quarantine structure. Now, let's bring my mic over here. In my first video, I talked about the 4 phases of Social Security filing, or the 4 phases of the Social Security retirement benefits life cycle, so to speak. I want to do a similar spectrum, just a little differently here. This spectrum is, I don't know what I'll call this spectrum, but let's just say it starts at age 60 and it finishes at my age 72. There are 3 stops that I will have along this spectrum, or at least 3 dates of note along this spectrum. The first one is 67. I was born in 1977, so my full retirement age is age 67. If you were born in 1954, your full retirement age for Social Security benefits is 66, which is this year, 2020. That's why I use that year as an example. I'm not going to, as you saw in that video, I'm not going to file for Social Security at age 67. Why? Because I want to wait until age 70, where I get those delayed retirement credits, 8% per year for 3 years, which is the maximum I can go, which means I get 24% more than what I otherwise would have gotten if I filed for Social Security at age 67. So if I were to check out of my work at age 67, between then and age 70, some of you may have been thinking this is, well, but there's a blackout period from an income standpoint. I mean, you're not getting any income. How are you going to claim Social Security 3 years late? And by the way, that's what many consumers think about, right? Wow, well, I'm going to retire at 65 or 66. Yeah, this delayed retirement credit thing, delaying Social Security, it sounds great, but I need income between now and then. What gives? How am I going to do that? I'll get to that here in a bit. But then at age 72, something happens. And that's where the IRS comes to us and says, yeah, Charlie, so all of that pre-tax money, that money you have saved that hasn't been taxed yet, traditional IRAs, for example, to where you've been able to deduct that against your income. Well, now it's time for you to start liquidating that account. Charlie, when you're 72, you need to take out 1, 25.6, let's call it around 4%. You need to liquidate 4% roughly of your pre-tax retirement balance. Why do they want you to do that? Well, again, it's because they want their taxes. And by the way, wasn't that so nice of them? The government, when we put money in, when we put that seed in our early years, they gave us a tax deduction on that seed. They gave us a tax deduction on that seed. But now at age 72, they are asking for their taxes on that harvest, what that has grown to, right? That is pre-tax retirement accounts. But at age 72, nonetheless, the United States government says for me, for some it's 70 and a half, but for me at age 72, that's when I have to start liquidating down those pre-tax retirement accounts. So let's go back over here and talk about that blackout period, so to speak. So a lot of folks may think, but yeah, at age 67, if you're retiring, you're leaving your job, which is not me. I'm going to do this until I die here. But a lot of people have the dreams of just, age 67 or 65 or 66, walking into the boss's office and, resigning, I'll say. Well, let's just say that that's me, that I close up the company at age 67. There's a concern there, right? I don't have the income that I did make before. And the problem is from 67 on, I may still have the need of that amount of income. And maybe that amount of income is $6,000 or $6,000 per month. How do I get that $6,000 per month? This is what most folks do. It's easy. It's kind of cruise control. It's kind of automatic. What most folks do is they'll say, okay, so at age 67, I'm full retirement age. I'm going to ask for the green. I'm going to file my Social Security benefits, which will give me, say, $3,000 per month. $3,000 per month, right? But you have a need of $6,000 per month. So how do you get that $6,000 per month? That's where the red comes in. That's where you say, well, I saved all of this pre-tax stuff up, and now I need to start withdrawing from that. Heck, I saved it for some reason, right? So now it's time to start enjoying my retirement, which I agree, it is time to start enjoying the retirement. Maybe not the mix and match way, which I'll get into here in a bit. So what happens is that additional $3,000, actually it would have to be more than $3,000 to net out $3,000. That additional to get you up to the $6,000, you take that from your pre-tax retirement accounts. That's what many people do. They eat like my wife eats, so to speak. You kind of mix it and match it up. What have you done there by doing that? What have you done by doing that? What you've done is, in many cases, is first of all, you have less of a Social Security benefit here than if you otherwise waited until age 70, right? You have less of a Social Security, that's obvious. And based off of everything that we said, you have less of a Social Security benefit here than if you waited until age 70. And I'll show you my example here where I wait till age 70. Another thing that has happened is that red that has come out to the tune of $3,000 per year, or per month, which is $36,000 per year, in addition to your Social Security benefit, what has that done by mixing and matching this up? What's happened is that adjusted gross income addition, which taking money from pre-tax retirement accounts adds to your adjusted gross income. Roth IRAs do not add to your adjusted gross income. Cash value life insurance, loans against a cash value life insurance policy generally do not add to your adjusted gross income. What happens is that adjusted gross income plus 50% of your Social Security benefit, that is your provisional income. Provisional income, right? What is provisional income? What provisional income is again, it is adjusted gross income plus 50% of your Social Security benefits, and technically plus municipal bond interest. You thought municipal bonds were tax-free. They are, but they can add to your Social Security taxation. But that provisional income, adjusted gross income plus 50% of your Social Security plus municipal bond interest equals provisional income. And if your provisional income is beyond, say, $44,000 for a married couple, upwards of 85% of your Social Security benefits, upwards of 85% of that can be taxable. If you, a married couple, have provisional income beyond $32,000, upwards of 50% of your Social Security benefits can be taxable. So again, first of all, what you've done here is you've minimized the amount of Social Security that you would otherwise be able to get at age 70. In addition to that, by mixing and matching it here, you could have led to the taxation of your Social Security. As a matter of fact, $36,000 added to your adjusted gross income plus $18,000, which is 50% of our other $36,000. That's $54,000 and beyond that $44,000 provisional income threshold of 85% of your Social Security being taxed. So that's the first and second thing that you've done here. In addition to that is relative to my structure that I'm about to show you, the quarantine structure, eating how I eat, eating my taxation, how I eat my taxation, versus that quarantine structure, what you have here is at age 72, you will have likely a larger required minimum distribution because that pre-tax balance is going to be larger. You will likely have a larger required minimum distribution than you will with my structure that I'm about to show you. So in short, this is how my wife eats, and that's how many folks that retire, that's how they do it, right? Because it's easier. You get your full retirement age Social Security benefits. In addition to that, you just start to deplete your pre-tax retirement accounts. What about my structure? So let's get rid of these, and let's assume again the same $6,000 a month need. So that's the $6,000 a month need. What if instead I said, you know what? For a ton of reasons, tax rates being low today, for example, versus what they're going to be. In addition to that, I'll get into the other reasons here in a bit, which is the point of this. What if I said, so that blackout period where I'm not earning anything, which means I'm not in any tax bracket as it is now. What if at that point in time, I just basically front end load my pre-tax retirement accounts. So that is what's going to get me by for the next 3 years. I then file for Social Security. To my point, what then happens? What's another reason? Well, another reason to do this is because your Social Security benefits are going to be higher. So not $3,000 a month. Technically, in my example, it goes up to $37,020 per month. Why? Because I waited until age 70. So what I've done here is I've quarantined this off from Social Security. I've relatively quarantined that off. Because what I still need to do here is I do still need to take some red, right? I probably need to take some red. Unless I have, like, again, cash value life insurance or some Roth IRA stuff, that I could take out at that point in time, which will have zero tax on it generally at that point in time. So relative to what I just did, what I'm talking about here is a quarantine structure. I'm able to get higher Social Security benefits as a result of that. In addition to that, as a result of me adding to my adjusted gross income only this amount versus the amount that I showed you previously, or said another way, adding to my provisional income this amount versus what I showed you earlier, I would be willing to bet that my Social Security taxation is either a heck of a lot less in this scenario versus my previous one, or it does not exist in this scenario. That's another reason to look at, to ponder this quarantine type structure. If you don't have a plan, make sure you get a plan when it comes to this quarantine type structure. There are programs out there that are beautiful. I have access to this. It can show you over your life, as well as on to your beneficiaries, which structure is going to provide, based off projections, the highest dollar amounts, right? But in addition to that, what have we done? What we've done here is we've certainly reduced a lot quicker our pre-tax retirement balance that the IRS is going to ask you to start to liquidate later on. So what that means is you are less bound to the U.S. government saying later on what you need to do with your dollar amounts, right? Because you have likely reduced that pre-tax retirement account balance a lot quicker than what you otherwise would have in the previous example. So think of a couple things here in addition to what we talked about. This blackout period here, Wouldn't Roth IRA conversions, wouldn't that make sense? Because again, you're not taxed on anything relative to probably what you were taxed on, what I would be taxed on prior to age 67, right? When I'm working. So wouldn't Roth IRA conversions over that period of time, yes, it will add to the larger amount of taxation between 67 and 70, but I would argue that the taxation there on those Roth IRA conversions versus later on, especially when tax rates are probably going to be higher, that may make sense, right? And from a legacy standpoint as well, Roth IRAs are not taxable to the beneficiaries. Roth IRAs are not taxable to the beneficiaries. So think of Roth IRA conversions there. In addition to that, think of minimizing required distributions. You know, this year, $24,800 is the standard deduction. $24,800. If you're over age 65, you get an additional $1,300 per person. So what is that? That's $27,400, basically your standard deduction. Think of calculating or having somebody calculate how small of a balance those qualified, those pre-tax retirement accounts would have to get to so the required minimum distribution does not exceed your standard deduction. Now, technically, you get more than the standard deduction before you're taxed, right? The first tax bracket for a couple starts at around $20,000. But a good tax planning practice is if you look at your pre-tax accounts and calculate that 4% on that roughly, will that be below the standard deduction? Certainly below the standard deduction plus, you know, whatever it takes to get to that first tax bracket. I hope that makes sense. And by the way, the standard deduction today and tax rates today, that's going to be completely different. I mean, it's all projections. In 2026, a lot of this stuff is planned, it's planned to sunset, right? So that's my way of saying, yes, you have to create a plan, you have to project, but just know that those projections should be updated as the years go by. So think of that. In addition to that, have a good day.